When you think of investing, do you imagine it as a fast-paced, thrilling activity only the ultra-rich participates in? I sure did. It is a common misconception that investing is day trading, stock tickers, and people screaming at each other. For regular people like you and I, the stakes are the missed opportunities to grow our wealth and achieve the financial freedom. Whereas in reality, investing doesn't need to be complicated or nerve-wracking, and anyone at any income level can start investing for long-term wealth accumulation and achieve the financial freedom that we always dream of. So in this video, I'll go over 3 signs that I received that I was ready to start investing. The first sign, the aha moment. See, when you get the realization that you should start investing, the first thing that you need to accept is no matter whichever financial instrument you're investing in, it is risky. There's a chance that the investment might go to zero and you will lose your investments. Keeping that in mind, when I had the realization that I was ready to start investing, I had to take 3 steps before I actually started investing. Step number 1, building an emergency fund. Now, ideally, this emergency fund is for 3 to 6 months of basic living expenses, covering your necessities like rent, utilities, groceries, and gas. It is a financial safety net in case of unexpected emergencies. But I want you to think of it that this is not a one-size-fits-all. Your safety net should be whatever you're comfortable with and you're capable of. Your investment should be the leftover after your savings. Second step would be to pay off your high-interest debts, such as credit cards, student loans, car loans, etc. Now, student loans and car loans could be minimized in certain situations, but the worst is the credit card debt. You should consider pay that off before you make any kind of investment. One of the ways to accomplish that is by contacting your credit card company to lower your interest rate. If not, consolidate the credit card debt into a lower interest loan. Want to learn more about it? You can watch this video here. The third most important step is to accepting the fact that investing could be boring, and compound interest is the most powerful tool when it comes to investing. I'm sure you've heard the financial gurus claiming to get rich overnight by certain investments. It never worked for me. Investments supposed to take time and grow over time as opposed to overnight. Your investments are way too risky when you consider investing in instruments which are supposed to make you wealthy overnight. For instance, an average market has to return about 7 to 8% annually over several decades. This means that your money invested can be doubled approximately in about 10 years. If anyone tells you otherwise, think of that investment twice before making it. Everyone's risk tolerance is different. You should find out what you're comfortable with and how much you're willing to lose. Again, this is not a one-size-fits-all. Therefore, not necessarily every single one of our risk tolerance would be the same. You need to find out what is your risk tolerance before moving forward. The second side would be the planning phase. Now, I was looking for the proper tools to start investing. If you're in the United States and if your employer offers you a 401k plan with matching contribution, you should definitely take advantage of this opportunity. You should contribute as much as your employer is willing to match, as this is one of the safest instruments of investing. So is Roth IRA. If you meet the income requirements, opening the Roth IRA has its tax advantages. It allows you to tax-free withdrawal at the time of your retirement. Besides that, there are also other types of investments, including stocks, bonds, ETFs, mutual funds, real estate, REITs, and commodities, and so many more. When you have multiple different kinds of investments, you are a diversified investor. Speaking of which, hi, my name is Tasir Mirza. I'm a realtor and a diversified investor based in South Florida. And on this channel, I make finance-related videos diversified. Consider liking this video as it helps the channel tremendously. Now, when it comes to the platforms, if you're in the US, use the platforms that are US regulated and FDIC insured. Platforms such as Vanguard, Fidelity, Schwab, Webull, Robinhood, and there's so many more. Most of these platforms has free trading. Obviously, they make the money off of the spread, which is a minuscule difference for you in the grand scheme of things. But absolutely don't trade in some offshore trading platforms which are not regulated or insured. Be cautious of the financial advisors who charges a percentage of assets under management fees, as these fees significantly can erode your returns over time. Consider paying an hourly or project fee for financial advisors instead. Now, the final sign, taking action. Your investment doesn't mean that you only invest in stocks, bonds, or REITs. Your investment could be a silent partner in a business or buying real estate. In any situation where your money is working for you instead of you working for the money is an investment. Do your due diligence before you make the investment. One advice that I can give you is do not invest into anything that you don't understand, no matter how lucrative or promising it sounds. If you don't understand it, don't invest it. One motto that I live by when it comes to investing is if the business can be explained to me in 30 seconds or less, it's a good investment. If it's more than that, I try to stay away from that. Talking about good investments, over 90% of my viewers are not subscribers of my channel. Now, I have a goal to grow this community 1,000 strong by the end of the year. Consider hitting the subscribe button below and joining the community. One thing you may not want to do is timing the market. As most of the financial gurus will tell you, buy low, sell high, but the best practice is to dollar cost averaging, which involves investing a fixed amount of money at regular intervals regardless of the market condition. This strategy is a way to smooth out the market volatility. This investment strategy could also be considered for diversification. Instead of buying hundreds of different kinds of securities, consider investing into index funds. This is one of my favorite types of investments, as my money is diversified among multiple different securities and companies. That way, it is easily diversified and avoids a lot of risk. Diversification and taking risk is what's going to get you ahead of 99% of people. If you'd like to know how I got myself ahead of 99% of people, watch this video here. Thank you for hanging out with me. See you in the next video.